But Myles, starting with you here, very much enjoyed the morning brief newsletter. You're looking at really the current state and the current composition of GDP.
Yeah, and really where this recovery fits into a historical context. Bob Schwartz over at Oxford Economics highlighting this in a note out over the weekend and looking at how long it took for GDP to recover its pre-recession levels. Now, as we know, last week we saw that first look at second quarter GDP where real GDP, that is inflation-adjusted GDP, exceeded what we saw in the first quarter of 2020, the first quarter during which the recession began. But that's a 6-quarter swing between the peak and the trough and then the return to the peak. And as we can see on this chart, that's normal. That fits into historical averages within the context of 9 recessions going back to 1953. And I think we have a couple of things going on here. As we can see very clearly on the chart, it was 13 quarters, so more than 3 years for GDP after the financial crisis to regain its pre-crisis peak. So that gets us all in this habit of slow growth. We're not going to bounce back. Really, the questions around the V-shaped recovery, certainly they had to do with the magnitude of the recession, but they were also benchmarked in part to the fact that we had seen such a poor recovery coming out of the last crisis. But something that I did note in here, which I think is very important to point out, the depth of this recession is unprecedented. We saw GDP, so total output. I mean, we report GDP as the annualized growth rate. We don't report it as the total dollar output. But GDP in the second quarter of 2020 fell to something like $17 trillion, 17 trillion low, let's call it. And that was the level that we saw in the fourth quarter of 2014. So 6 years of GDP output was lost just in one quarter, which is by far the biggest hole we've ever seen the economy fall into. And so, okay, it's an average length of recovery, but we exceeded the prior record, which was hit during the financial crisis, of, the way I think about it, years lost of the economy. We exceeded that record by 50%. So maybe we should give the recovery a little more credit, but I just thought it was an interesting way to frame sort of where we are today.
And very important framing, because we've seen most companies, when they report earnings this season, going back and comparing to 2019 levels, has been one of the most important comparisons so far this earnings season.
Well, and another part of this is how GDP is comprised. Right, and we highlighted this work out of Deutsche Bank a couple of weeks ago, where they looked at if you look at GDP sectors and then port those over to sectors within the S&P 500, you essentially have 2/3 right now of the S&P 500 of S&P 500 companies growing at faster than pre-recession levels. And the work that Deutsche Bank did suggested it's really more like 2 or 3 years before companies regain their pre-crisis growth trajectory. Now, we're getting into all sorts of compositional conversations around corporate earnings versus the way GDP is calculated, so on and so forth. But basically, the work that Deutsche Bank did suggested that this is the fastest recovery we've ever seen. Then again, we've never had trillion-dollar companies. 5 trillion-dollar companies, four at least right now, and we've never seen that kind of heft within the S&P. And of course, those are all the big winners, right? Your Facebook, Alphabet, Amazon, and Apple. So. And I guess Microsoft $1 trillion. So $5 trillion companies, depending on where Facebook is this morning. We've never seen those kinds of numbers. They're growing the fastest. Therefore, they're creating the most output within the S&P. And how they calculate the GDP is a little bit less forceful than how they feed into the index.
And just staying on this topic, where I think you're saying this peak growth topic that we've been talking about, U.S. July ISM factory gauge, that headline number fell to 59.5 from 60. The estimate was at 61. Now, also, let's worth noting here, we also saw some disappointing China manufacturing data coming in into today's session.
We did, but we also then, on the other side of that, we see ISM or IHS Markit out with its own manufacturing gauge. That came in at the highest on record, and that data goes back to 2007. So you still have these kind of conflicting. I guess they're conflicting. They're both saying the economy is in a good place. But to your point, ISM data is suggesting that we are in this peak growth phase. The IHS Markit data, which we got out about 20 minutes ago, is suggesting that the manufacturing sector is still in the best condition that, as far as their work suggests, that it's ever been in. And, another way to, put some the proper context around these numbers, it shows how quickly the sector is growing. So output didn't fall, right? It just grew at a slower rate, as you see it on the lower third here. And so I think that question, and we were talking about this, Michael Kushman, that question for investors is, how do you understand the economy through that part of the cycle, through a slowdown in overall growth, even with growth still continuing? And I think these data set up for more interesting conversations on that front.
They do, and I go back to what we were talking about with Keith Lerner over at Truist earlier on. Peak economic growth does not mean peak stock prices, and we're seeing that today. A little bit of disappointment. We've seen it on the GDP. We've seen it now in manufacturing. Stocks continuing to do well.
Yeah, and also within both of these data, you're continuing within both of these reports, which are survey data. So it's not just tabulating. It's not the way that the jobs report is done or CPI is done. It's a little bit different. It's a little more contextual, let's call it. You're continuing seeing supply chain problems, right? So if the supply chain is what's constraining growth, are we really at peak growth? The market, I think, given the way the stock market has behaved, suggests the answer is no. Because it's kind of an artificial governor on growth, if you see what I'm saying. Are
you psyched for Jobs Day?
Well, you poo-pooed it. So, I could try to be excited about it, but you're sitting here being like, I don't care about the jobs report.
You be you.
Also, the estimate will change. The estimate will change. Yeah. But 888,000 is a great number for a number of reasons. Yeah. First, we're in the 8th month of the year. Love the symmetry of 888. Yeah. China's been a big story. 8 is a lucky number in China. We all remember Beijing Olympics started 08, 08, 08, which, given we're in the Olympics, is another tie-in there. I mean, there's a lot to like about that setup, but because more people will put their guesses in, that won't be the estimate.
If we hit 888, I'll buy some Shake Shack. All right,
if we hit 888, you have to find 8 people in our office. I don't know if you'll be able to find them, but we have to find 8 people in the office, and then all of them get Shake Shack.
Deal. All right, coming up.